Welcome to PCBcast. I'm delighted to have with me Charles Yang, the Business Development Manager of Molo, and Sam Harley from Cedar Crest, a mortgage broker there.
Thank you very much, Sam, for hosting us. I'm the international BDM at Molo International. I look after a lot of the international relationships.
Thanks for the invite, Sam. I'm a mortgage broker at Cedar Crest. I'm personally based in Hong Kong, but we also have a team in the UK and Singapore. And we're predominantly focused on helping expats and non-UK residents finance their UK property purchase, whether that's for investment or their own use.
Fantastic. It might just be helpful if we begin by doing a little look back to the last few years and how you've both seen the financial market in terms of residential property over the last few years, and particularly buy to let. And I obviously see things very much from the legal perspective, and I get a sense and a flavor of what's happening in the finance world. But you guys are obviously on the front line, and I'd imagine it's been a fairly turbulent few years. Tell me a bit about your experience and what you've seen. I'll start with you, Charles.
Having, I believe it was 13 rate increases has been a little bit of a challenge for quite a lot of borrowers and also ourselves as well. What's been a little bit of a blessing is we're a new entrant in the lending in the BTL space. So I guess we've come in at the top of the market, but certainly we're seeing that in terms of borrowing capacities, repayments being at the higher end of the market for quite some time. I think it's certainly a bit of a challenge for investors at this moment in time.
You make a really interesting point there, actually. Tell us, when did Molo decide to start lending into the UK market, and what was driving that decision? Because as you've said, it seems like maybe quite an odd time to do that potentially.
Yeah, look, our headquarters is in Australia. We had been looking at expansion into the UK for quite some time. So certainly this was not something that we decided on the fly about 2 years ago. It was certainly something that we've been looking into for quite some time. And it just happened so that our entrance into the market was at the peak of interest rates. Now, at the same time, in terms of the Molo acquisition, there was also something that we believe we did very well, which was international clients. So we worked with quite a lot of international clients purchasing property in the UK or inside Australia. So it was a very easy fit for us to look at the same client set, being the international clients. I probably can't say too much about the domestic side of things because I unfortunately don't have as much oversight over there. But in terms of the international market, yeah, it was because of a lot of due diligence and also having a fundamental demand that there was quite a lot of international clients looking to purchase in the UK that we look to participate in this particular area.
So international clients very much a specialty for you and your team. And I think that's something that all three of us have in common, actually. And Sam, tell us a bit about your client base and what you've seen over the last few years.
Cedar Crest basically started 2019, so that was actually quite a good time for us being in Hong Kong, because that was just at the start of COVID where interest rates were still low. There was stamp duty holiday. So there was a lot of activity at that point when we first started. So that kind of blindsided us a little bit when interest rates started increasing, especially just as interest rates in general are higher in the international and expat markets. It became quite difficult for everybody in 2021 to 2023. I think 2024 was easier, but it's not so much that it's difficult. It's just it takes longer, I would say, for clients to now process. Interest rates are at a higher point. They're taking more time to think about, okay, we need to probably get more funds together to complete a purchase. So it's more about the education process and the whole process taking longer, I think, just because interest rates are at that higher point.
Would you say, this is probably a question to both of you, would you say that you've seen a dip in volume levels, international borrowers, or is it more of what Sam's saying, just the fact that things are taking longer and maybe being a bit slower to come to fruition?
My views heavily skewed towards Hong Kong. I don't think volumes have necessarily, they have reduced slightly, but I wouldn't say by a huge amount. It's more so you're talking to a lot more people that are researching the market and in that still consideration phase before they actually are ready to pull the trigger, because it's just taking them longer to make decisions.
And Charles, you might not have the same kind of data set to go on, as you've not been lending into the UK for as long, but Maybe you could talk more globally. Is that a trend that you've seen worldwide? And has it had an impact on general appetite, or is it just that things are a bit slower at the moment?
I think the fundamental appetite's always been there. There's been always demand in terms of migration to UK or Australia, or there's the migration portion, there's also the investment portion. So there's quite a lot of related aspects in terms of housing being a fundamental requirement for a lot of people. So I think the underlying demand probably hasn't changed, but I think to Sam's point, the education piece really has become much more important.
Definitely. And it's interesting that you both mentioned that because I've observed in through various market cycles that we've experienced that there is that education phase where suddenly you have this end of a very good run usually, and things go a little bit quieter, a little bit slower. And then when that starts to pick up again, there's a phase of having to educate buyers, in your case, borrowers, and it feels like there's a lot of tire kicking going on for a while, but actually it's really good use of our time and the value that we provide in educating the marketplace so that when they are ready, that's when that rush happens again and we're back into a busy market. So it does seem, although there have been some really headline grabbing turbulence, say 2 or 3 years ago, we've definitely got through that fairly unscathed, I would say, unless either of you disagree. And now we're in that phase of building back the market again. And although it can feel like a bit of a slog, I've seen enough of them now to get quite excited because I've got a good feel for what's coming, hopefully. I think that really sets us up nicely for the current outlook and maybe what we think of what's coming. So how are you seeing things at the moment? How's the start of your year been? Sam, let's start with you.
Yeah, so definitely more optimistic looking forward. We started to see a few banks reduce rates a little bit, which is just a good sign. Sorry, from maybe not this year, but towards the end of last year, we've seen some banks decrease rates. Just from our company's perspective, we're busy with a lot of completions. So they were obviously clients that had bought properties a couple of years ago that are coming through to completion. So that's been keeping us busy. And then in terms of the seminar circuit, it's quite big in Hong Kong, Singapore, and some of the other Asian markets. So that seems to be picking up again, a lot more face-to-face activity, where last year was a little bit quiet. So yeah, I would say I'm more optimistic than last year, but still not getting over-optimistic.
And in terms of, you mentioned interest rates and banks lowering them, I assume you mean certain lenders, but also central banks as well. And I personally don't like to try to forecast and predict the future, and I'm sure you don't either. But what's your general feel for the direction of travel for interest rates and central banks included?
I think with the overseas market, just in terms of the lenders that are available, even if the Bank of England base rate does decrease, you don't tend to see that reflected in the product rates very quickly, if at all, shortly afterwards. So yes, I do feel that the Bank of England base rate will have some further reductions this year. Don't know how many. I don't necessarily think that's going to be immediately reflected in rates from the lenders that are in the market for the international buyers.
Do you think it would then maybe filter in next year? So there's just going to be a bit of a lag between what's happening at the nationalistic level to what's happening on the retail level?
It's normally a short to medium term lag, I would say. You have lenders like HSBC that are technically in the international market, but the majority of people can't access them. For the majority of lenders in the expat and international market, it tends to be a lag following reductions in the domestic market.
And Charles, is that similar to how you see things as a lender yourself?
Just a few points on that. I think the first point is probably in terms of having the BOE have the 25-point drop. I think it's certainly in terms of an actual repayment drop for a lot of clients, because I think there are clients who are on variable tracker rates who benefit from that drop basically right away, versus clients who are on fixed rate who probably don't feel that drop. So in terms of actually lowering overall repayments in the whole portfolio, I don't think there's been that much of a drop. But I think what has really changed is the sentiment. I think that having or knowing that the rates are coming down, and more than likely, I would say, of course, we don't have a crystal ball, more than likely, they're probably continually going to come down this year, as I think buoyed this excitement that the BTL is probably going to be a lot more exciting for us. So certainly, I think in terms of inquiries, I'm sure Sam probably spoke about this. Is yes, there's definitely been this higher sort of level of activity in regards to having the rates drop. But in terms of actually having the interest rate come down, I think there's probably two components. One being the variable component, which I would say has come down, but typically it's traditionally higher. Whereas the other component is the fixed rates, which is priced according to the future swaps. The swaps have probably already priced the rate drops already. So in terms of the fixed rates that are coming down, we probably haven't seen that much of it happening right now, but certainly would hazard a guess in the next couple of weeks to probably months, they would certainly be going down too.
Okay, that's good news, and that feeds into the optimism and the sentiment, which I think is key, and I think it's something that we're going to keep coming back to throughout the conversation. You raise a really important point, Charles, and I'd imagine it's a very pertinent question at the moment, especially with rates changing, whether borrowers should, or perhaps you can't answer that, but what trends are you seeing as fixed versus variable? And I'd imagine there's more of a tip towards variable at the moment, given both. I'm happy to say I also think interest rates are probably going to go down, so I'm happy to make a slight prediction there. So all three of us have that view, and that would mean presumably that variable should probably be a better option at the moment, or does it not work that way?
I think Sam's probably better equipped to answer this question than I would. But I think in terms of what I'm seeing is this, I'd say probably maybe 12 months ago, it was more skewed towards variable because for the anticipation of the rate drops. I think right now there's probably maybe a 50-50 mix in terms of fixed rates versus variable rates, because I think there's I guess the swaps are saying that rates are coming down, and I think a lot of borrowers are saying, look, they're happy with where it is, as opposed to taking the current variable, which is a little bit higher.
Sam?
Yeah, I would echo that point. I would say there probably isn't. If we look at our clients and look at, okay, how many are choosing fixed versus variable, it is probably about a 50-50 split. It's really down to the individual client's circumstances and what they want in terms of flexibility. Because, yeah, fixed rates at the moment are sitting lower than what you would get as a product rate on a variable rate. But there's always that type of client where they don't mind paying a slightly higher variable rate because the expectation is that rates are going to go down, or they want that extra flexibility to repay the loan faster, which you get with a variable rate. So yeah, I would say it's not either or at the moment. It's pretty even.
How does that compare historically, generally, and also particularly in the last few years? Has that been more skewed towards fixed rates in the past and now it's leveling up, or would you say it's representative of the norm?
I would say up until the first year of COVID, you could get 5-year fixed rate extremely low. So people would go for that. But then also before the Bank of England started increasing rates, what you would see is that actually the shorter term fixed rates, like 2-year and 3-year, were actually still higher than a variable rate. But that's sort of flipped at the moment, where the variable rate's sitting higher than everything from a product rate perspective. But that still hasn't really put people off from going for it because it comes with the extra flexibility.
So it really is a very personal choice then, isn't it? Because the numbers come out in the wash. The variable, when variable is more attractive, it will be a higher rate, and vice versa, and that sort of thing. So it really comes down to what's right for the individual.
Yeah, and from my experience with Hong Kongers, Singapore investors, they always like the option to be able to pay off the loan faster. So yeah, we see it's pretty even.
Yeah, that's a really important factor, isn't it? If that's something you're planning to do, not to have to pay early repayment penalties. Excellent. So let's talk a bit about the difference between a conventional domestic borrower and an international borrower, because I'd imagine there's probably a very different set of criteria that would be applied to an international borrower versus a domestic borrower, which most people listening probably would already be very familiar with. So I think it's going to be really useful for us to cover those differences, particularly as that's something that we all focus on. So Sam, is probably, I'd imagine, your best place to cover that initially.
Yeah, I would say really nowadays there's not a huge amount of difference in terms of lending criteria. It's more so the differences in calculating affordability. So whether you're a domestic client or international, the banks are still going to want to know the information around source of funds. Where's the money coming from the deposit? I don't feel like that's much different, whether it's a domestic client or an international client. Maybe you'll disagree, Sam, in terms of the due diligence you had to do, but from a lender perspective, it doesn't seem to be much different. And then, just in terms of affordability, it is different. So if people are paid in different currencies, then there's obviously haircuts that need to be applied to the income when they're calculating how much they can borrow. It can be more difficult if you're self-employed and live overseas to find lending options, but that's where brokers are there to help find those options if you have unusual income structures or you're self-employed overseas, for example.
Is that something that's more difficult for international buyers than local buyers? Because being self-employed, I think locally is also can be challenging.
I would say that if a lender does lend to self-employed people overseas, then the process is the same. It's more so number of lenders available is much less. If the lender needs to verify audited accounts and tax returns from overseas, they might just say, no, we're not going to bother with that. But if they do lend to self-employed people, then the process would be quite similar.
And Charles, how about yourself? Do your thoughts echo what Sam has said, or does it work slightly differently with Molo?
I think I'm very much in agreement with Sam. I guess the fundamentals in terms of credit policy is really exactly the same, whether it's domestic or international. Where it's different is the application of the credit policy across the different jurisdictions. Sam said inside Singapore and Hong Kong, they would have separate practices in terms of taxation practices and also what we call retirement EPF and MPF being contributions into retirement funds. They have different practices and availabilities, nuances that's available for clients in terms of income and also being able to access those types of income. So our policy sort of changes depending on the different jurisdictions. So it's about understanding these nuances and also the different nuances in the different jurisdictions to be able to support the client in the best way we could possibly do.
So let's add another layer of complexity, or maybe not. You might tell me it's not. What about borrowers wanting to use an SPV or a company to purchase a property? Is that something that makes life more difficult, or maybe it makes it easier?
From our point of view, it really doesn't change in terms of credit policy. Like we're fairly agnostic to whether a client wants to use an SPV or use individual names. What we're most interested in is the controllers of the SPV. So how we limit that is we don't allow very complex SPV structures. Probably the furthest we go is probably 2 levels in terms of SPV, and also we don't allow overseas SPV structures. So it's getting ourselves comfortable around who the controllers of the SPV are and having them as borrowers to the loan is our fundamental thoughts on SPVs.
Yeah, and Sam mentioned earlier about our own source of funds checks as lawyers, and it's a slightly different angle because it's coming from the anti-money laundering perspective rather than the affordability angle, although they both very much overlap in both directions, obviously. And it's similar with using a company. We just want to know who the ultimate beneficial owners are, who controls the company, as you say. Sam, you might be a good person to ask from a financial perspective if there are any pros and cons for using an SPV versus a borrower. I'd imagine it's going to be subjective again, but are there considerations that we should be thinking about when we're making that decision?
There's 2 questions there from a lending perspective. I guess back to your original question to Charles. There are lenders like Molo that are very flexible and will look at buyers that are buying inside a limited company. Then there are lenders that just don't do that. They will only accept buyers in personal name. I think that's starting to change just because it's becoming so popular to buy property inside a limited company for those financial benefits. So there's definitely tax advantages for buying inside a limited company from a paying corporation tax instead of income tax perspective, and also just being able to offset more of those costs from the final tax bill at the end of the year. So yes, I would say there's definitely financial benefits to owning in a limited company, but it's not a clear-cut decision because interest rates tend to be slightly higher, all other things remaining equal for lenders that lend inside limited companies. So yeah, for people that are buying multiple properties in the UK and building a portfolio in the UK, I think it definitely starts to make sense. If for people that are just buying one property, maybe it wouldn't.
I think you really hit on the key word there for this decision making, which is tax. And probably none of us are really qualified to go into detail on that. So really the point is, especially as you say, Sam, if someone's building a portfolio, you should always be thinking about the tax implications. And one of the things that might come up as a sensible route is to use an SPV. And that's something that your tax advisor would be able to advise on. And we actually talk about it in an old podcast as well. Although things are ever evolving, it's not particularly necessarily going to be an evergreen conversation. I think you've answered one of my questions, which is whether lenders were becoming stricter against SPV structures, but it sounds like actually it's going in the other direction. And Charles, Molo will already lend against SPVs fairly happily. So it seems like the lending marketplace understands that this is a very much a key part of certainly investment as a property investor. The availability seems to be fairly decent, albeit it might come with a few restrictions. While we're on the nuances of the lending landscape, are there any differences between portfolio landlords and first-time buyers? Might a first-time buyer have a different experience to a portfolio landlord other than not being so familiar with the process?
I can give some context from a broker perspective. So I would say the biggest difference there is once an investor owns 4 or more investment properties, then lenders tend to consider them a portfolio landlord. So up until that point, the lenders are really only looking at that individual property that they're considering lending on in terms of rental coverage, deciding how much they will lend on this particular property. Once a client becomes a portfolio landlord, lenders then have to look at the whole portfolio before they can consider lending on the next property, for example. What they're looking for there is that the overall portfolio is washing its face, as they call it. So the rent is covering interest within a certain stress test. So the biggest difference there from a client perspective is that there might be less lenders on the market that will lend to a portfolio landlord. And then from a documentation point of view, they're probably going to ask for more documents to understand the whole makeup of the portfolio.
So it seems like whenever there is a nuance like this or an additional kind of layer of complexity, really the impact is going to be the availability of lenders. It's going to be a narrower pool rather than something that's fatal to be able to borrow.
Absolutely. So I'd say one of the strong things about the UK lending market is that there's so many lenders available that can cater to different situations. So most of the time, there's always a solution out there.
There's always a solution. And would you say that you're finding that borrowers have to compromise a lot in certain situations, Sam, or is it just a narrower pool, maybe not the best possible terms, but still pretty manageable?
I would say yes, still pretty manageable. I think on the international markets, you're sometimes limited by the country of residence. That can be quite a limiting factor to the lenders that you have available if it's a high risk country, for example. For those that don't live in high risk countries, then I would say there's normally going to be a solution.
And Charles, from your perspective as a lender, where do you sit on that spectrum? It sounds like certainly with companies, you're very open to that. Would you say that you're fairly broad in your lending criteria, or are there certain things that you're completely against?
There's probably very rare instances where it's an absolute hard and fast no. We'd like to be able to say yes, because it's a policy is ultimately a model, and then it's a model around trying to understand people and finances, and we understand everyone's unique. So I think certainly there may be a potential issue. There's also a potential mitigation, and I think we always try and have that conversation with our brokers. Is in the example earlier, is a client a portfolio landlord? Do they have a large portfolio? And the mitigation to that, which Sam alluded to, is does a portfolio wash its own face? We certainly have to do extra due diligence in regards to that and ask for more documentation, but the mitigation is in existence. And certainly we look at a portfolio landlord as a type of a borrower, and also we look at a first-time landlord as a borrower as well. Yes, we do understand that they may be the lack of experience in purchasing property in the UK, but at the same time, they certainly have maybe quite a lot of mitigating factors around this particular client being very financially strong, being very astute, etc.
Excellent. I think this leads us quite nicely into a discussion around the role of mortgage brokers, which obviously I'll hand over to Sam on initially in a second. What seems to be coming from this conversation is that there's a lot of pragmatism in lender's approach, Molo's approach, also the role of the broker is navigating those nuances, and there's no black and white situation, and hopefully there's always a solution in there somewhere. So I think certainly for first time borrowers, they might have a very one-dimensional view of borrowing. Either you can get the finance or you can't, and there's this rate or that rate. But actually, what's really coming clear from this conversation is that there are a lot of dimensions to this. And someone very new to the market would certainly benefit from having their hand held and just being the benefit of an experienced broker like yourself, Sam. Tell us a bit about some of the other benefits of using a mortgage broker and the value that you really bring to the table. And then perhaps we'll then go on to ask Charles his experience of working with brokers and how that works versus direct lending. Why should I use a mortgage broker if I'm looking to get finance for my property investment?
To start with, I think the biggest misconception about brokers is that we're just there to find the lowest rates, the bank offering the lowest rate and say, you go, here's your mortgage product. We provide much more value than that. It's really about taking a client through a journey in terms of understanding, okay, what are your goals for buying a property? What are your long-term goals for buying property in the future? And finding a lender that's going to suit those circumstances based on their income situation in the country they live. Not only that, the actual property they're buying, because obviously different lenders have different appetites for different types of properties. Their long-term plans, are they planning to build a portfolio in the UK? Would certain lenders fit that more than others? So just really understanding the clients before we even start thinking about lenders. The second would be, okay, once we understand your circumstances, it's not all about interest rates. It's about what lender is firstly going to lend you what you need, and what lender is not going to make life difficult for you to actually get the mortgage and complete the purchase on time, especially if you're buying a new build property. And then we're there to handhold you through the whole process and collect all of your documents, preempt any questions that the bank are going to ask, obviously deal with the application process, and really take as much headache away from the client as possible to make the buying process as smooth as possible. So I'd say that's where we really add value. It's not just about sourcing a mortgage product.
And I can speak to that personally from my work as a lawyer, and the team will definitely second that, because obviously it doesn't affect us actually what interest rate borrowers get on their mortgage. So we're only dealing with the practicalities of getting the mortgage drawn down, usually for a new build completion, which can be under extremely tight time frames and a lot of stress. And they're talking about financial aspects. Again, there can be penalties, interest and costs for late completion. Completing smoothly and on time is a real value to borrowers. And sometimes that can be compromised by not using the right lenders. Obviously, a borrower is not going to have that information and that experience as to which lenders are good or bad for that kind of thing. That kind of insight is invaluable. And perhaps Charles may also second this as well. Having that extra point of contact, that extra person to follow up on things, to communicate, to liaise, to coordinate, really helps with the smoothness of that process as well. Charles, how do you find working with brokers? And perhaps you can speak to some of the benefits that you see on your side when a borrower uses a broker.
Absolutely. Molo is very supportive of the broker channel. We think there's a lot of value there because certainly a broker presents, educates, and also filters, and then ultimately simplifies the market and does as a presentation. But at the same time, probably what Sam didn't mention, which we see as a lender is very valuable, is the broker is also an advocate for the client in terms of what I was mentioning earlier, possible sort of blemishes or possible issues the client may have, and advocating and mitigating these issues before it even becomes an issue or becomes something that has to be considered from a lending credit point of view. So certainly, as we mentioned earlier, sometimes we do get into situations where we may have missed repayments, And at the same time, we don't want to exclude clients just because of one misrepayment or two misrepayments. We'd like to understand the circumstances. So having a broker be able to analyze the information and also be able to ask the right questions and also be able to present the facts before the lender starts looking at it is very valuable. And then also comes to a much quicker decision making. The other point that I wanted to make is there's also the structuring element of the mortgage as well. That's very invaluable. The lending product that's available out there in the market, it's not one dimensional. It's not just a LTV and an interest rate. There's a little bit more to that. There are facilities that are available. For instance, in just the Molo package there, that we do have Aura accounts, which are very unique to our product proposition. And what it means is sometimes it could save a lot of hassle for clients and also provide a lot of economic benefits to the client by using their Aura. Certainly knowing these things and knowing about the structuring element and getting the structuring right for borrowers, I think it's beyond just the LTV and the interest rate sort of conversation.
Definitely. And talking about hassle structure for clients, it's obviously important that clients end up in the right place and with the right product. And that's no mean feat, I'd imagine, in matching them up in that way. And it's going to take, obviously, as Sam mentioned, the knowing his client, not from I don't mean from a KYC AML perspective, knowing the client and their needs. And there's all that due diligence and getting to know the client and building the relationship that happens with the broker. What kind of thing does the borrower need to prepare and be ready for, Sam? There's a fair bit of priming and readying that you do with an applicant before you approach a bank. Talk us through that process a little bit, and perhaps if you can give some pointers to those listening, if you can come to your broker with this ready, you'd be the ideal client and things are going to go a lot smoother for you.
I'll speak about it from the perspective of an international client, as that's mostly what we do. What's always important for UK lenders looking at overseas clients, and can sometimes catch clients out if they're applying directly, is although the client lives in a different country, the UK lenders still want an understanding of what commitments that client has in their country of residence in terms of rent, mortgages, credit cards, that kind of thing. So even if the lender doesn't specifically require a credit report, for example, I will always start at that point with the client in terms of, okay, what are your current commitments in your country of residence? Because we don't want to get caught out by this later and the lender find, okay, you've got a personal loan or a mortgage that we didn't know about, that they spot on the bank statements, for example. So we always use that as the starting point. What's your income structure? Are you self-employed or employed? And what are your commitments in your country of residence? Because that really helps us also in terms of finding the most suitable lender. If we understand immediately what other properties, what other mortgages do they have, what kind of income structure do they have, that gives us a really clear picture in terms of what's going to be the right lender for them. So if I had to tell a client what to bring to me, I would say credit report in their local country of residence and a clear picture of their income structure in terms of not only their employment, but also if they have rental income. And then the final thing I would say is that to open a UK bank account if you don't already have one, because there's been many occasions where clients have came to us after the fact of applying directly and they don't have a UK bank account, which they would need for a UK mortgage.
And I'd imagine that's going to create a bit of a delay if they don't have that by the time they got to you.
It can cause some panic, especially if it's a new build.
Charles, so in light of what Sam just said, what are the kind of key risk factors that the bank will look at when assessing an application, and also the sort of flip side of that, what would make a borrower more attractive to the bank to lend to?
In terms of lending, it's all based on policy and models. The three principles of credit is serviceability, security, risk. So serviceability, the ability to be able to make repayments. Now, certainly there's the two traditional methods, which is the ICR method, which is the ability for the property to wash its own face, or the portfolio to wash its own face. And also another method that we have is called full affordability. I know it's not always available to all lenders in the UK, but certainly it's a model that we use called full affordability, which is basically going through all the net income for the clients, all the liabilities of the clients, and modeling what we call a minimum expense that the client has, and then seeing if there's a surplus that we can use to apply to the new lending. So that's fundamentally the serviceability, and certainly a client who exhibits better serviceability is going to be better. The next one is the security. A lot of that is just understanding the property, the location of the property, the condition of the property, being a good condition property, being a property in a location where there's robust transactions. These would be factors that make the property more desirable versus, let's say, a property that's very rural that might not have a lot of, that might not have a lot of transactions. So that would be the security type considerations. And the last one is just the risk. And I guess that's the borrower risk themselves. Sam's point on having the credit checks, understanding from the credit profile, is there a history of a lot of misrepayments? Is there histories of judgments or bankruptcies and things like that? Certainly these are sort of factors that are looked upon quite negatively, but certainly I'd say they're not always exclusionary. It's certainly, as I always say, that we'd like to understand the circumstances. Could we mitigate this? Could we understand why these things happen? And is there suitable mitigations in place that the client can provide to help with the mortgage?
So it sounds like you need to build an holistic picture of the borrower. And again, it's going back to it being subjective. You're not going to necessarily rule someone out based on one negative flag on their application. It's going to be taking a look at the bigger picture and making an assessment that way. And how much do the criteria change over time and evolve? We talked at the very beginning about previous market conditions. Do your models change much over time to adapt to those market conditions, or are they fairly set?
The high level side of things, which is the serviceability, security risk, this sort of doesn't really change. I think what changes is right now, I guess we're in a current sort of interest rate decreasing type environment. So certainly I think in terms of what we put on buffers in terms of the interest rates, we're looking probably to relax those type buffers just to make it easier on affordability because of the drop in interest rates. What probably changes is also in terms of the different jurisdictions, because we support such a wide range of different jurisdictions, all the way from Dubai to Singapore to China to Hong Kong. As the regulatory changes happen in each of the different jurisdictions, we certainly change our models or change our policies around that. We certainly look to update those. But in terms of the fundamental credit policies, that probably doesn't change.
Yeah, so it seems like a mixture of the core fundamental criteria, which are more or less fixed, and then there are some more market condition dependent elements that will obviously change as market conditions change. That's very interesting. And I have to say, I'm really learning a lot here, because as much as we deal with finance and mortgages and securing finance against properties for our clients, we're very much focused obviously on the due diligence of the property side, and then the anti-money laundering aspects for the client. So in terms of our visibility and just general expertise in lending criteria and those sorts of things, I'm really learning a lot from both of you. So I really appreciate the conversation. One thing we haven't covered, which perhaps we should before we round up, is when someone's refinancing. So they already own the property and they already have a mortgage with a lender. How much of what we've discussed is different in that situation? The application process, the assessments, all that kind of thing. If I had to guess, I would say it'd probably be a bit easier because they've obviously already been through some process. But as I say, I'm quite ignorant on these side of things. So I could be completely wrong about that. Sam, how much is it different when it comes to refinancing versus your first mortgage against property?
If your product is coming to an end and it's time to refinance, usually we would get in touch with the client sort of around 6 months before that's due to happen. Firstly, just to sit down with them again and just to understand if there's anything new with their situation, but also to assess whether the best thing for them is to stay with the current lender, because whatever current lender they're with will offer them some new products to keep their loan with them and stay with them. Usually that's a much more simple process because they've already onboarded to that bank, and in that situation, the most that would happen is that the bank might just ask to understand if their employment situation is still the same and ask for potentially a couple of updated documents around income proof, etc. If the client is looking to refinance to a new lender, then I would say the process is almost exactly the same as at a new purchase in terms of KYC from the bank, affordability checks, all of that stuff. It's almost as if it's a new application. The only difference is that there's not the same level of source of fund checks from the legal side. But obviously, if they do refinance to a new lender, they would still have to get a lawyer involved to change the lender that's registered on the property title and deal with the lender's legal requirements. So it's actually quite a similar process. We really have to understand whether that is worth it from the client's point of view to justify those costs as well to refinance to a new lender. So I would say refinancing is still quite an involved process from the broker point of view.
Yeah, it's interesting. And Charles, do you tell us about your processes when you've got a borrower that's maybe coming towards the end of their fixed term period and your general sort of outreach for existing clients, and on the flip side of that, onboarding new borrowers who are refinancing rather than taking a first mortgage on the property?
Yeah, absolutely. So I think it's very consistent with what Sam is saying in terms of a client that's reaching the end of their product. The process is very much simplified. I'd even hazard go so far as to say, in terms of if the client's been able to demonstrate good repayment history for the term of their product, we probably wouldn't even need updated supporting paperwork in terms of income documentation. It's very much just what we call a product variation or a product transfer to a new product. Ultimately, we'd like to be able to make it as easy as possible. Now, to Sam's point about if it's a client that's coming in brand new or being onboarded brand new, it's a little bit more complicated. It does take a little bit more time, being that it's a completely new client to us. They would need to be KYC'd again. They need to go through the affordability models. But what does make it easier is they've had the track record of the property. We're able to see that the property receives a certain amount of rent. We'd probably be able to see the client's performance in their repayment history. So these factors do make it a little bit easier for the client if they're looking to remortgage.
You've answered my next question there. I was wondering how much comfort a lender might have by the fact that the borrower has already passed somebody else's checks, all three factors that you mentioned themselves, the repayment, the risk, and the property itself. So the fact that has already been verified, albeit by a previous lender, which you've had no involvement with, that does give some comfort, does it, to
Yeah.
for you to know that hopefully it should all be fine, really. Okay, great. I think it would be good to round up, and if we just circle back to where we started the conversation. So our outlook for 2025, and maybe we can discuss beyond as well. It seemed like we all had a fairly optimistic sentiment. And I will put you both on the spot and ask you just to give me a rough prediction of how you see things playing out. Obviously, heavily caveated. No one's expecting you to have a crystal ball. But how do you see the next few months and years playing out in terms of both the UK property market, but also specifically the lending aspect of that? Charles, I'll put you on the spot first.
Look, I think, as I said earlier, I think we're in a interest rate decreasing environment. What does actually give me a little bit of concern, it's just not keep me up at night, but certainly worries me a little bit. It's certainly what's happening in terms of politics in the US, actually, the Trumpflation. So certainly after COVID, the central banks worked really hard to bring the inflation down, but there's elements in geopolitics where there could be inflationary pressures that are coming back in again. So I think balancing the two different forces are probably still going to have the interest rate decreases by the central banks, but probably not as fast as what everyone's predicting. Now, there's the other factor that's also being talked about is that there could be the possibility of a recession in the US as well. That's also a counterforce to the inflation, which could actually accelerate rate decreases. So I've contradicted myself in my own thoughts in this particular question. So certainly, look, I think the general sort of outlook is definitely rate drops, but there's two different forces at play that could swing it either way.
Yeah, I don't think it's really you that's contradicting yourself. I think
Yeah.
that's just the nature. We've got headwinds and we've got tailwinds, and it's just a very heady mix of different things. I've realized as you started to answer how unfair my question was. When you think about the political backdrop, it's very difficult to predict how this year is likely to play out. And even Trump seems to be changing his mind every day. One minute there's a tariff, the next minute he's rowing it back. So it's hard to predict day to day at the moment, isn't it? But hopefully positive for property investment, which is seen very much as a safe haven, and gold has obviously been doing very well.
If you don't mind, I just jump in there, but that's probably to your point that despite the headwinds, I think UK properties are probably looking safer and safer as well.
Yeah, exactly. So there's always good and bad in everything, and never more so than at the moment, as you say, Charles, when you saying you were contradicting yourself. But actually, I think that's just a very balanced assessment of the landscape. Sam, your thoughts?
From my point of view, obviously it's difficult for me to say exactly what's going to happen with rates, but I think the general outlook is that there's going to be slow, steady decreases in the next few years. Just from a UK investor perspective, the fundamentals of the UK market still remain attractive to overseas investors. And also from the domestic market side, or from a British expat side, or people that are just wanting to buy properties for their own use, that still remains attractive for people. People still want to buy homes in the UK, whether they're planning to return in the short term or in the long term as well. So the fundamentals of the market remain strong for the future. So just cautiously optimistic on lending rates.
Excellent. One thing that always seems to come out of these conversations, no matter what the topic, is the fundamentals. And we talk about UK property as a safe haven. It's because the fundamentals underpinning it are so strong. And you look particularly in, say, London, which obviously has been a very tough market for a number of years now. Hopefully, I think there's some cautious optimism there as well for this year. But the fundamentals of demand and supply, which underpin everything, and home ownership, which underpin very much part of British life, aren't going anywhere. There are these ups and downs, these headwinds and tailwinds, but ultimately the fundamentals remain. So I think we can always be cautiously optimistic about that, hopefully. I'm going to put you on the spot again. I always like to end the episode with one word to sum up the conversation, one word for a takeaway, if you like. I'm happy to go first, and my word is pragmatism, because a real insight that I've taken from speaking to both of you is that it's not this one-dimensional tick box yes or no exercise. There's something out there for everybody. If someone's serious about property ownership, and particularly property investment, whether they're based domestically or where we all specialize internationally, there is a solution for them. And with the right help and the right expertise, they can navigate that landscape and find something hopefully suitable. So my word is pragmatism. Who wants to go first?
I'd be happy to give it a go. My word is enjoyable. I absolutely love this industry. I love mortgage lending, and I love the broker industry as well. And I'm just thinking, like, in terms of this forum, having Sam and yourself, Sam, being able to talk with both of you and having your expertise and also your experiences in the different areas is very interesting.
Great. Thank you, Charles. And Sam?
Echoing what I just said 5 minutes ago, confidence. I feel confident about the UK market long term. It's a safe jurisdiction to put your money. It's an exciting industry, real estate and the lending industry as well. So that would be my word.
Fantastic. Very positive note to end on there. Thank you, Sam. So if anyone wants to get in touch, what's the best way for them to contact either of you or your teams? Charles?
Contact Sam. His experience in the industry is invaluable to a lot of borrowers or purchasers of property inside the UK. International purchases. Being a specialist lender, having a specialist like Sam vet the clients, and also having educated the clients makes the process for a lender in terms of onboarding and also post completion, having the customer service experience, just a much better experience for clients overall.
Great. Well, Sam, how do people get in touch?
Yeah.
Thank you, Charles. You can reach me personally on my LinkedIn. It's just Sam Harley, or my email address is sam.harley@cedar-crest.co.uk. Feel free to reach out at any time if you have any questions.
Excellent. Gentlemen, thank you very much. And I'd just like to echo Charles's comments about it being a very enjoyable conversation, certainly for me as well. So really appreciate your time, and thank you.
Thank you very much.
Thanks, Sam.